When people talk about investing, one name almost always comes up: Warren Buffett. Revered by both Wall Street professionals and everyday investors, Buffett's reputation is built on decades of consistent success and a down-to-earth approach to money. His folksy wisdom and sharp business acumen have made him a household name, and his annual advice is eagerly awaited by millions. Known as the Oracle of Omaha, Buffett transformed Berkshire Hathaway from a struggling textile mill into a global financial powerhouse. What began as a modest business in the heartland of America is now a symbol of smart investing and steady growth, thanks to Buffett's vision and leadership. Today, Berkshire Hathaway is a vast collection of companies, owning iconic brands like Geico, Duracell, and Dairy Queen, while also holding major stakes in giants such as Apple and Coca-Cola. This diverse portfolio reflects Buffett's belief in investing in businesses with enduring value and strong consumer appeal. Buffett's investment philosophy is famously simple: buy wonderful companies at a fair price and hold them for the long term. He spends countless hours reading financial reports, analyzing businesses, and searching for opportunities that others might overlook. He looks for businesses with strong competitive advantages, what he calls moats, that can withstand competition and protect profits over time. These moats might be a trusted brand, a unique product, or a loyal customer base. Unlike many investors who chase quick profits or jump on the latest market trends, Buffett avoids quick trades and market fads. He focuses on patient, value-driven investing, believing that time in the market is more important than timing the market. This disciplined approach has built immense wealth for shareholders and made Berkshire's annual meeting a must-attend event for investors from around the world. Each year, thousands flock to Omaha to hear Buffett's insights and celebrate the company's achievements. His shareholder letters are legendary, packed with timeless lessons on business, investing, and life itself. They are studied by students, CEOs, and aspiring investors alike, offering wisdom that goes far beyond the stock market. As of August 2025, Berkshire stands as a fortress of finance, a testament to disciplined long-term investing and the power of compounding returns. The company's stability and resilience have made it a beacon in the financial world. Against this backdrop, Berkshire's latest move has captured Wall Street's attention and sparked intense debate as investors and analysts alike try to decipher what Buffett's next big play might mean for the future of finance. UnitedHealth Group, the largest private health insurer in the U.S., has long been a Wall Street favorite, but 2025 brought a wave of challenges that shook its reputation. The Justice Department launched a probe into UnitedHealth's Medicare billing, questioning whether the company inflated codes for higher payments. The investigation threatened massive fines and regulatory penalties. In May, CEO Andrew Whitty resigned amid mounting pressure, fueling uncertainty about the company's direction. Then, UnitedHealth withdrew its earnings outlook and issued a sharply lower forecast, confirming that its troubles were hitting the bottom line. The company's year of expected growth turned into a period of crisis. Investors were left wondering if UnitedHealth could recover from this storm. The barrage of bad news sent UnitedHealth stock into a tailspin. Once seen as a safe blue-chip investment, its shares plummeted nearly 50% from their peak. Billions in market value vanished, and the company's price-to-earnings ratio dropped to decade lows. The market's confidence was shattered, and UnitedHealth's reputation as a stable leader evaporated. Financial news outlets debated whether this was a temporary setback or a sign of deeper trouble. The company became a symbol of corporate crisis, with trust from patients, doctors, and the government at risk. For UnitedHealth, the fall was both financial and reputational. The healthcare titan had stumbled, and its future was suddenly uncertain. Would it ever regain its footing? Just as UnitedHealth's outlook seemed bleakest, Berkshire Hathaway made a bold move. In its second quarter 2025 filing, Berkshire revealed it had quietly bought over 5 million shares of UnitedHealth. This $1.6 billion investment made UnitedHealth a top 20 holding in Berkshire's massive portfolio. The move was surprising given Buffett's past criticism of the U.S. healthcare system as costly and inefficient. Yet Berkshire's purchase signaled high conviction, a belief that UnitedHealth's troubles were temporary. While others fled, Berkshire saw opportunity, making a classic contrarian bet. The investment suggested confidence that UnitedHealth's core business would outlast its current crisis. It was a powerful statement. Even amid scandal and leadership upheaval, Berkshire saw value. The market was left to wonder, what did Buffett's team see that everyone else missed? Berkshire's move turned the spotlight back on UnitedHealth's long-term potential. News of Berkshire's stake in UnitedHealth sent shockwaves through the market. The so-called Buffett effect kicked in, with UnitedHealth stock surging over 10% in after-hours trading. Investors rushed to buy, seeing Berkshire's move as a powerful vote of confidence. The narrative shifted from doom to hope. If Buffett saw value, maybe the worst was over. Analysts scrambled to reassess their outlooks, searching for hidden strengths in UnitedHealth's business. The endorsement halted the stock's free fall and injected optimism into the company's story. For shareholders, it was a much-needed lifeline. The market's focus turned to what Berkshire saw beneath the headlines. The Buffett effect had changed the conversation and the company's prospects. Berkshire's UnitedHealth investment is a textbook case of value investing, buying when others are fearful. This approach, famously championed by Warren Buffett, means looking past the panic and focusing on the underlying value of a business. It's about having the courage to act when most investors are running for the exits, and the headlines are filled with doom and gloom. UnitedHealth stock was battered by scandal, leadership change, and profit warnings, but its core strengths remained. While the market was quick to punish the company, a closer look revealed that its essential business model and competitive advantages were still intact. The noise of the moment overshadowed the company's long-term prospects. The company's scale, data analytics, and industry relationships made it a dominant force in healthcare. UnitedHealth's ability to leverage vast amounts of data and its deep connections across the industry gave it a unique edge, allowing it to weather storms that might sink lesser competitors. Berkshire likely saw the market's panic as an overreaction, creating a rare bargain. When fear takes over, prices can fall far below a company's true worth, and that's when disciplined investors step in. The decision may have come from Buffett's trusted lieutenants, Todd Combs or Ted Weschler, known for bold, contrarian bets. Both have a track record of spotting value where others see only risk, and their influence has shaped many of Berkshire's recent investments. Regardless of who pulled the trigger, the logic was classic Berkshire: bet on a strong moat and long-term recovery. The company's enduring competitive advantages, or moat, offered protection against short-term turbulence and set the stage for future growth. The investment was a wager that UnitedHealth's legal and leadership issues would pass, and its earning power would return. Berkshire's patience and confidence in the company's fundamentals signaled a belief that temporary setbacks wouldn't define its future. By buying at a decade-low valuation, Berkshire positioned itself for substantial gains if a turnaround materializes. This kind of disciplined, opportunistic buying is what separates great investors from the rest, seeing value where others see only trouble. It was a move against the crowd, true to the Berkshire Hathaway way. Going against the grain isn't easy, but it's often where the biggest rewards are found. Sometimes the best opportunities are found in the midst of crisis. For Berkshire, buying when there's blood in the streets isn't just a saying. It's a proven strategy for long-term success. Berkshire wasn't alone in spotting value in UnitedHealth's beaten-down stock. Regulatory filings showed other top investors like Michael Burry and David Tepper were also buying in. Burry, famous for The Big Short, is known for deep research and bold contrarian bets. Tepper, a master of distressed investing, saw UnitedHealth's troubles as survivable. Their moves signaled that the sell-off may have been overdone. When multiple legendary investors converge on a stock, the market pays attention. Their collective bet suggested UnitedHealth's fundamentals remained strong beneath the turmoil. The smart money was betting on a comeback. Berkshire's UnitedHealth buy was part of a broader portfolio shakeup. The company also initiated new positions in homebuilders Lennar and D.R. Horton, steelmaker Nucor, and others, signaling a search for value across sectors. At the same time, Berkshire trimmed its massive Apple stake and slightly reduced its position in Bank of America. These moves reflect prudent portfolio management, locking in gains and avoiding over-concentration. As of quarter's end, Berkshire's top holdings remained Apple, American Express, Bank of America, Coca-Cola, and Chevron. The addition of UnitedHealth and other new stakes showed Berkshire's willingness to seek opportunity in out-of-favor sectors. The firm is actively balancing new bets with careful management of its biggest winners. It's a dynamic approach, always searching for value. Berkshire's bold UnitedHealth investment comes at a pivotal moment as Warren Buffett prepares to step down as CEO, passing the torch to Greg Abel. This transition marks the end of an era defined by Buffett's legendary leadership and the beginning of a new chapter for one of the world's most closely watched conglomerates. The move could be seen as one of Buffett's final contrarian plays, an audacious bet that defies conventional wisdom, or perhaps the first bold step in Greg Abel's vision for Berkshire's future. Investors and analysts alike are watching closely to see whether Abel will follow in Buffett's footsteps or carve out his own path. For UnitedHealth, Berkshire's backing is more than just a financial boost. It's a powerful lifeline of credibility and stability at a time when the company faces mounting challenges. The endorsement from such a respected investor sends a strong signal to the market and to UnitedHealth's employees. The investment gives UnitedHealth's new leadership team the breathing room they need to address complex legal and operational hurdles. It also provides a sense of reassurance to stakeholders as the company works to rebuild trust and chart a course through uncertainty. If UnitedHealth manages to rebound, Berkshire's bet will be celebrated as yet another value investing masterstroke, proof that patience and conviction can pay off even in turbulent times. The rewards could be significant, both financially and reputationally. But if the turnaround fails, the investment will serve as a cautionary tale about the risks that even the most seasoned investors face. It's a reminder that no one, not even the Oracle of Omaha, is immune to the unpredictability of the market. This story captures the drama and uncertainty of the market, a titan in crisis, a legendary investor betting on recovery, and the ripple effects that follow every bold decision. The stakes are high and the outcome is far from certain. For Berkshire, it's another chapter in a long history of going against the crowd, embracing risk, and trusting in the power of long-term thinking. The company's legacy is built on such moments of courage and conviction. For UnitedHealth, it's a shot at redemption, a chance to prove resilience and adaptability in the face of adversity. And for everyone watching, it's a reminder that even in the midst of crisis, hope and opportunity can still be found.